Hey guys, welcome back to MLD Money Matters, where we break down the forces shaping markets, portfolios, and the future of investing. I'm your host, Chad Larson. So thanks for joining us. First off, today's episode is an important one. At MLD, our investment process has always been grounded in identifying structural themes early, long before they become consensus. And over the years, that discipline has guided our positioning across things like gold during periods of monetary instability, defense amid rising geopolitical risk, healthcare through demographic and innovation cycles, and more recently, private credit as traditional capital markets retrenched. With these themes have in common is timing. They mattered not because of headlines, but because the underlying fundamentals were quietly shifting. Today, we believe energy represents the next major structural theme, one that is still widely misunderstood, significantly underowned, and mispriced. Over the last decade, energy has been treated as a sunset sector, and yet beneath the surface, a powerful realignment is underway, accelerating global power demand, disciplined capital allocation, surging data center and AI-driven electricity needs, and a wave of consolidation that is reshaping the industry from the ground up. Recent geopolitical developments only reinforce this reality, whether it's rising global conflict, supply chain fragmentation, or the renewed focus on energy security. Events such as the recent escalation involving Venezuela remind investors that energy is not just an economic input, but a strategic asset. In this environment, passive exposure and surface level analysis fall short. Understanding energy today requires deep industry knowledge, local relationships, and active management. To help us unpack this, we're joined by one of the most respected voices in the energy space, Dave Szybunka, Senior Portfolio Manager and Managing Director at Canoe Financial. Dave and his team sit at the center of Canada's energy ecosystem with deep relationships across producers, private equity, and the companies driving the next stage of the energy cycle. He's been articulating a 15-year energy cycle long before it entered the mainstream narrative, combining rigorous data with on-the-ground insights that few can replicate. Today, we'll discuss why energy demand is accelerating faster than supply, why markets continue to misprice the sector, how artificial intelligence is driving power demand, what consolidation means for long-term returns, and most importantly, how investors should think about positioning for the next decade ahead. This is a timely conversation for investors looking to cut through the noise and understand what's really changing beneath the surface. So with that, let's dive in. So first off, Dave, thank you so much. For the viewers, I've been trying to get Dave on the podcast for months, and this is the first time we're able to connect schedules. And so the funny thing about that is, we're teed up, on the back of the U.S.'s involvement, or I'm not going to call it an invasion, but with Operation Absolute Resolve, with Nicolas Maduro being captured by President Trump, we will tie into that, but I don't want to distract the conversation on this one thing. That these are, and I'd written an article which I'll share recently, but it's shock and volatility for the short term, and that's normal. But I wanted to really have Dave on to talk about the energy super cycle and establish that macro thesis. So with over to you, Dave, and let's dive into it right away.
Yeah, so you said a lot there, and we'll talk about a bunch of the various things that you talked about.
Yeah,
Um,
let's. And I didn't tee you up the question. I apologize. So you've said before that we're 5 years into a 15-year energy cycle. What is the market still getting wrong about global energy demand?
yeah, so I mean, you referenced the word super cycle just to kind of be clear. Like, I don't think we're in a super cycle. I think we're in a commodity cycle.
Uh,
Okay, I actually think we're in a super cycle for power as a kind of sidebar, which we'll talk about later. But like, I think we're in an energy profitability super cycle because the capital's reluctant, the capital's hesitant. Yeah, but are we going to need oil? This is all slowly changing as we think about where we are today versus kind of say 3 years ago. People are getting smarter on these topics. Um, but the one thing I would say to you is like, investing in energy is a very investable theme, right? And just to kind of talk through some of those high level points, like the world uses 300 million barrels a day of energy equivalent. This has been growing at a pace of 5 million barrels a day of energy equivalent growth each and every year for the last 20 years. But we actually see this inflecting to 6 to 9 million barrels a day of energy equivalent growth as you think about just kind of the developed world versus the developing world. And Like they're using 3 barrels per person per year of oil. Well, in North America, we use 22 barrels per person per year. Like there's like 7 billion people in the developing world, 1 billion people in the developed world. So you have stuff like that. There's 100 million people a year moving from rural centers to urban centers between now and 2030. You have this energy demand tied to AI that simply wasn't in the cards here 2, 3 years ago. So there's these structural shifts happening beneath the surface, and that touches power, that touches oil, that touches natural gas, that touches uranium. Like your energy manager is excited about how you see this big structural path, but kind of still the lack of embracement to the sector. I think that's the big tee up, right? As I just think about a 50,000 foot view for the sector.
Yeah, and I should maybe set the table a little bit to viewers, listeners, readers alike. I think one of the misnomers, maybe less in Canada, definitely not so much in Alberta, but really like when we talk about energy, so many people just default to oil. It definitely dominates a lot of the conversation. But within the portfolios, there's four drivers. That it's the subsector approach that energy is much more than just oil and gas, and it isn't as homogeneous as you think. And I'm glad you touched on that. So I really want viewers to take a step back. We'll maybe dive into a little bit of uranium and stuff backwards as we get through it. So you know we're going to talk a bit about data center power demand, because this is maybe a little bit of a bump off the conversation that we kind of planned to have, and maybe just a reason for me to speak, which is common throughout these podcasts. Um, I've been doing this for 22 years, and for the as far back as I can remember, we talked about that migratory pattern shift of people going from into the middle class and using more energy. It's quite funny from a behavioral finance or from a perspective of how people think, is that the longer a theme is around, the more they start to discount it. When in fact, like you said, this has been 20 years we've seen growing energy demand. In fact, does that not make it more investable? And I think we lose sight of that. Some new shiny thing comes along, software as a service, or AI, and everyone kind of runs like a locust. But for 20 years, this has been building. Do you want to talk a little bit about data center power demand? And I'm hearing demand is set to quadruple, over the next decade. How does that structurally change the energy investment landscape?
Yeah, so let me say a couple things on that and then tie it into the bigger side of things. And so, like, just on data center demand, just to kind of just paint perspective for people so they understand how when I said this just simply wasn't in the cards and what that means. Between now and 2030, when you just look at the US, like, there's going to be 40 to 60 gigawatts of incremental power demand from data centers, just from data centers. And to put this into perspective, 1 gigawatt powers roughly a 1 million person city. And so in the US today, there are 11 cities over a million people. And we're going to pop up 40 to 60 new million person cities between now and 2030. Like this is staggering, right?
Yeah.
This amount of step change is staggering. And guys like me are just like, I actually physically don't know where you're going to get the power from, because of how I just laid that out on how hard this is going to be. And so that's where I said, like, I think we're in a power super cycle because I don't know where you're going to get. And when you're in a super cycle, what does that mean? It means you structurally own things tied to that and buy dips along the way. And you trim some of these goofy rallies, you buy some dips, but you structurally own it for multiple years on that thematic. And I know you do, Chad, within your portfolios because you've been on some of this. So inflecting this kind of more to the macro on what you talked about, on how there's been kind of people embracing AI, but not these other areas and stuff like that. Look, our view at Canoe is how you've made money the last 20 years, call it 10 years, 20 years. Like that was a different regime than what we're going into. And interest rates have been coming down as you peaked in the 80s and you've been coming down, and you've been in kind of periods of deflation, and there hasn't been these big roaring inflations like the 70s and stuff. The world's got along. It's been globalization. Like when you look for what are the structural pillars that you want to have that are multi-year themes for a commodity cycle. That involves periods of populism, deglobalization. You want to see stuff like, what is it, deficits, energy security. Like these are the themes that we have right in front of our faces.
Yeah.
And when you look at those bigger structural themes, that's not what the world's looked like the last 15 years. And that's what it looks like today and going forward. I don't see this deficits all of a sudden getting under control and all these governments are running balanced budgets. It's not going to happen. So when you have those pillars like I described, you want to own hard assets and commodities. And this is going to become a 60-40 portfolio that's been the theme. It's going to be 60-30-10 or some version of that. And that 10% sleeve is going to be commodities. So I fit in the middle of that as an energy guy, right? And I would tell you that when you look at what's the world been grabbing onto the last 12 months or whatever, gold, copper, silver, like these commodities are very highly correlated as you look at longer term charts. They all move together. We're in a currency debasement cycle. And when I look at energy and think about how the cycle ends, well, the cycle ends when energy is outperforming other sectors for multiple years and the capital's coming in and the weightings are going up within the S&P 500. And you saw that in kind of 2012 to 2014 and the capital's coming in, the private equity guys are back and grow, spend.
Everyone's blowing their brains out. Yeah.
Yeah, and you kind of think about, again, how do commodity cycles end? Shortages, price spikes, governments taking care of their own people because they're worried that their prices are going up too high. Like the world's dividing, Chad, and all these things are starting, but all those things about how cycles end that I laid out, that is not where we are today in the energy sector. In the energy sector today, there's reluctancy, hesitancy. It's only 3% of the S&P 500 is awaiting. It's underperformed other sectors for multiple years. There's no spending cycle happening in energy right now. Well, there is when it ends and investors embrace the spend. So the balance sheets are pretty good. Like I feel like we're just waiting and bumping along.
Yeah.
But I think this macro is already shifting before our eyes. But it's not like energy is going to the moon, but these other commodities are giving you triggers. And 2020 gold led. Then copper came in behind. Then energy was the place to be. Then no one liked gold kind of 12 months ago. Now everyone likes gold. Now they like copper. Like it's one big trade, right? And that's where I think we're at.
Yeah, and that's a perfect tee up, into kind of this segment two, that we're going to talk about, because it's quite interesting. Is being early is dangerous. Being late is so what's the right word without sounding rude? It's so typical, of retail investors. And so when I look at our weightings, me as an allocator overseeing as a fiduciary of overseeing clients' capital, is you got to lace up your boots. You got to get there. You got to get invested to be interested, et cetera. And so now, as our clients know, we've made a tactical weighting into position capital with you in one of your core funds, and we look to build that as more and more signals develop. Because with segment two, we were going to talk about energy's valuation discount, contrasting fundamentals with current market sentiment. You started to, touch into that about, energy being one of the lowest weightings in public markets in decades. And, maybe, why are the public markets so complacent towards energy despite exceptional fundamentals?
Yeah, I would tell you, like, to lay it out. Like in 2021, 2022, when commodities were just going and inflation was ripping and like the macro was shifting for the first time in like decades, right? And so that created pain in other sectors when that happened. And I would say for the last 3 years, we've been going sideways as other sectors have been outperforming.
Yeah.
Why has there been reluctancy, hesitancy, all these things? Like people kind of say like, yeah, your funds did really well last year. You're kind of up 25% round numbers, up 25 the year before. Like we've been outperforming the sector.
The sector's been
hasn't
flat.
done anything. Yeah, the sector, like to be clear, if you've been overweight energy massively the last 2-3 years, just in indexes, other sectors have been the place to be.
Totally.
So,
Oh, listen, gold
like,
did all the heavy lifting for us last year.
yeah,
And it's about sector allocation. The, back on that theme, and I just didn't to be concise on it, the complacency, in energies, but at the sector level, from a stock performance standpoint, energy, it's been, flat. And we look at some of the dispersion between, some names have done really well, some have done terrible, but the median, and you guys have outperformed. And so we'll get into your process later about how you approach, being selective within the subsectors. We won't get into, one of the things we're limited to. I'll tee you up and poke you for a couple like key takeaways near the end. But energy at the business line level is delivering more shareholder cash than any other sectors. Why it's an obvious one. Why aren't investors rewarding that yet? And if energy is becoming that growth sector again, as your valuation charts suggest, how do we look at that as weightings? Like, what is the historical weighting now to the S&P? And from simple math, the weighting has gone down, not because the companies are smaller, but because the valuations and the return profile. We just look at the Magnificent Seven, to begin with. Like, they've done so well, it kind of dwarfs everything. If you got one 8 foot tall person on your team, everyone else on the basketball team starts to look pretty short. Is that kind of what you're seeing in that rebalance that will come? And then how does that happen? I don't want to scare people, and Dave and I have talked about this at length. Is two things are going to happen, and maybe a combination there of both. Either there's a correction at the upper echelon, either the 8 foot tall basketball player, breaks his knee, or maybe the short guy starts to grow and hits a growth spurt.
yeah, you kind of laid out a lot of where my head's at. And so, again, like when you think about these commodity cycles, just again, like for investors, go pull up a 10-year chart of the Bloomberg Commodity Index. Like it peaked in Russia, Ukraine. It was going down for multiple, like 18 months, 2 years. It's been kind of going sideways. And now you're starting to see these random gold, silver, coppers, whatever move up. And so again, like I told you, these commodities, when you kind of have this influx of commodities and they're pushing higher, that is not good for multiples in other sectors. Yeah, but oil won't play. Well, 100 years of history tells you it well. As you look at money supply and how oil's correlated with that and these bigger macro themes of debasement, and we're in a currency debasement cycle. And so, like when we look at oil prices today, you're damn near close on oil prices relative to the cost of getting it out of the ground. And when you look at that standard deviation, it's not to say it can't go a little lower,
Mm-hmm.
but it just isn't going to go that much lower for that long, I don't think, for where we're at in the cycle. And so to kind of tee this up, there's three stages of an energy cycle: disbelief, optimism, euphoria. Those are the
Yeah.
three stages. We're still in disbelief. And that's where you kind of teed it up perfect of like, well, when are we going to get out of this disbelief? I don't know. Like we've been going sideways for 2, 3 years here. Is it another 6 months? Is it? But I actually think we're closer today on moving out of this disbelief stage to optimism because of our points of entry, right? When you think about Russia invades Ukraine in 2022, oil was $100. Today it's 58, right? Natural gas was 9, now it's 3. Inflation was 9%. It's been coming down. Interest rates have been up. All we've heard from the US administration in the last 24 months has been Powell's got to cut. We got to cut. Powell's got to cut. Cut, 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 cut. The energy sector does not traditionally do well in an interest rate cutting cycle.
Mm.
It's when you start removing the cuts. It's
Yeah.
when the commodities surprise, when everyone's been looking down. It's when you look at the Exxon Chevron earnings that have already retraced 50% from 2022. The average retracement when you go through these mini checkbacks in the bigger commodity cycle is 50%, and it takes 2 years.
Okay.
We're at 60%, and we've been going sideways for 30 months. So all of these things are leading me towards of like we're getting closer to the next leg of commodities go up when everyone's looking down.
Yeah.
OPEC's been bringing down spare capacity. The world's becoming a more unstable place. This is probably a good influx into Venezuela. Like the world's barrel counting, looking at all these things. The biggest takeaway for investors is if you think China and Russia are fine with what just happened out over the weekend, you're wrong. Like,
Yeah,
get ready
real
for
wrong.
your next geopolitical event. Like, China invades Taiwan. Like, it's coming, you guys. And then people will gravitate to, well, who has the commodities and how are they going to get them? And this is not a Canadian crude is out, Venezuela crude is in.
Yeah,
This is a US shale is not going to be producing where it is 10, 20 years from now. The US is doing a smart thing to align itself with more sources of heavy oil,
yeah,
right? And I
yeah,
think it's a Canada and Venezuela thing, not a just Venezuela thing.
yeah.
And that's what the people need to figure out. Like, again, another data point for you. 18 months ago, Mexico was exporting 1.2 million barrels a day of heavy. Today, they're only exporting 700. Like a lot of that heavy went to the US.
Yeah.
They're missing this heavy barrel and they're trying to source it to be energy security tied for Americans, right? And so this is where the puck's going. I think it's all going to align. I think we're getting closer to moving out of this disbelief stage to optimism. And when that happens, those transitions in the market tend to kind of be violent. So
Yeah.
to to finish off what I was saying, I think we're going to be moving from some version of a growth market to value or growth to commodities or however that's looking. And these transitions sometimes are quite messy. And are commodities the driver of that? Like, are oil prices spiking while everyone's bearish and short positions are at 30-year highs? If it is, you should be overweight today, right?
Mhm.
Or is it a more, there's a bit of a global slowdown or something, and we kind of go down a bit, but the pains in other sectors because commodities really don't go down that much and they start going up and the back of the curve is actually rising because deficits are so big. I'm not going to be the macro expert, but I think energy's not the risky area of the market of what I'm talking about.
Yeah, yeah, no, I agree with you. Let's jump into segment three, and next we're going to talk about consolidation and near oligopolies, and maybe explain, why industry structure is better, than last cycle. What does today's industry structure with fewer companies controlling more resources mean for, long-term investor returns? And how permanent is the newfound discipline around CapEx, debt, and production growth? Living here in Western Canada, I always, we've joked, we'll leave the names aside, is, I look at some CEOs running, large energy companies here in Canada, and so, they still have PTSD over they went through their last downturn, and balance sheets seeming are robust. Companies are free cash flowing, their share buybacks. Is the consolidation theme priced into the market yet, or is the best still yet ahead? We've seen some landmark transactions recently. How many people are left? And what does that mean for the sector?
Yeah. So again, another good tee up and just to kind of again, if you looked at Northeast BC land map kind of in 2014, it's like a colorful rainbow. There's so many
Yeah,
companies. You look at
I
that
think
land.
I owned land up there at one point. It's like,
Yeah, fair enough. Everyone owned land up there. There's
yeah,
junior. But like again, that was the structure of the energy sector. Too many companies, too many energy portfolio managers. As soon as the price goes up a little bit, they all react to price. They're all raising equity. They all bring the MPV forward to press on the gas pedal. A Northeast BC land map today is controlled by 5 companies, right? Tourmaline, as an example, controls 50% of the liquids in Northeast BC, 50% of the condensate, butane, and propane. Like that is crazy. So you look at CNRL leading into COVID, 1.1 million barrels a day. Today they're 1.6. Tourmaline was 300,000 barrels a day pre-COVID. Today they're 650, 700,000 barrels. Whitecap was 70,000 barrels. Today they're 370,000 barrels. You look at the ARC 7G transaction. You go south of the border. Chevron buys Hess. Exxon buys Pioneer. Like there's all this consolidation happening. And what is happening right before our eyes? Oligopolies are forming. And when oligopolies form, it's good for profits, right? If you sit down with the CFO of EQT and you talk to that guy, second largest gas producer in North America, hey, like, do you think the winter's going to be good and gas could go up? Yeah, it could. Will you drill in anticipation of? Why would I do that?
I don't
Like
have to. Yeah,
if I get a price signal with the curve and the curve moves up and I can make a good return for my investors, I will give the market growth if that's what they're calling for. But until I get my price signal, why would I do that?
Instead of
And
blowing your brains out into terrible
these are
price
the
curve. Yeah,
structural forces. And I would just say, too, companies on average are spending 40 to 60% of cash flow on CapEx. This used to be a way higher percentage.
sure.
So when the commodities go down, they tweak the CapEx down a bit. When the commodities go up, they tweak it up a bit. But when the commodities go way up, they just hand a bunch more money back to shareholders,
Yeah.
right?
So does that mean balance sheets have low debt and equity issuance is rare? And I think one of the things you mentioned to me is like you talked about these land maps being consolidated. Does scarcity premiums emerging in top tier assets? Is that what you would expect?
Yeah,
And it's almost kind of like duck, duck, goose, like who's next?
you just nailed it, man. Like the theme for investors on what I just said is scarcity of quality resource. That's the theme. If you lay out that theme on what I just said, like Murray Edwards has like the sector has been handing back money, doing shareholder returns, buybacks, dividends, all this stuff the last 2, 3 years. It's all
I,
great.
I remember, the name escapes me. You'll probably know it better, and no foul if you don't. There used to be like a physical energy magazine that I used to get early in my career, and it would just list off like the production and the debt and the cash flow per share of the large caps, the integrateds, the mid caps, the small caps. And I remember over years, like it used to be pages and pages long, and then you could just see like those pages and pages shrinking. Like it's pretty bad when a generalist, not a specialist like myself, can almost name 70% of the productive capacity in Canada,
Yeah,
off of memory. And again, and I'm a generalist, not a specialist. Is
yeah.
that does that with that maybe we kind of jump into the next part of the segment, which is public versus privates. I know within your strategies you have the ability to have a sleeve, of privates, but contrast the behavior of sophisticated institutional capital, with public investors, and and some of those key points, from some of the memos we shared back and forth. Private equity is pouring tens of billions into energy quietly, while public investors sit on the sidelines. So what does that tell you? What are the private investors seeing that the public markets are missing? And does this set up a potentially explosive rotation in energy when sentiment shifts again? Because the smart
Yeah.
money gobbling this up.
Yeah. So, I mean, we've talked about the macro. We can see the commodity cycle brewing. When does this exactly happen? I don't know. You don't know. We're looking for signs. Don't get too bearish given where we are. Like, these are all the things that we've talked about. But I just kind of outlaid a big theme that investors should focus on is scarcity of resource. So this is happening in front of our eyes. The public markets have been complacent on energy to call it out because they've been making money in other areas of their portfolio, right? So there's no need to go buy some energy stocks and go overweight as other things are still working. That's going to have its day in the sun. But the fundamental setup here is already happening, and the multiples are starting to expand for certain assets and companies in this digestive phase that we've been in because of the pools of capital showing up. The companies are in good stead. Hostile bids are going on with the Strathcona Megs. You're watching the corporates and Synovises come in and up their bid multiple times because they can. They're feeling that there's not another 5 megs behind. Now the private equity guys are there. There ain't just a couple, man. There's the most private equity money I've seen here in 10 plus years trying to put capital to work. They see this power theme. They see how Alberta can fit into that. They see the sticks on the map that screen better than their US sticks on the map with shale, right? They see the long life reserves in the oil sands, all of this stuff. You've watched the pension capital that completely exited Canadian energy and energy, period,
Yeah.
in 2020, 2021. Now the pension guys are back. You're watching CPP do US LNG deals in the Gulf Coast, right? On natural gas. So these things are starting to come back. You watch Saudi Arabia come in here in the summer and buy 20% of Petronas' Northeast BC assets, become a 5% owner in LNG Canada. You watch Total Energy come in to buy into an indigenous LNG facility on the West Coast. You watch these Canadian energy companies go to Europe, and on the back of the conference, the National Bank conference in Europe, multiple buy orders come into the sector. Then you watch a bunch of these producers go to the Middle East as the Middle East guys are bidding them JVs for their land in our backyard. So everything I'm describing is like why the multiples are expanding in the sector. I go and do a bunch of presentations and everyone's like, when's Carney going to build a pipeline? What about Venezuela? They're getting sidetracked from what I'm talking about. Like
Scarcity
the,
of resource.
the
Yeah, it'll
public
find its way
markets
out.
and the privates, I feel like I'm in bull market land when I talk about the privates like I just did. I
Yeah.
do not feel that way, but those two things are going to align at some point, right?
Yeah.
And when you have the thing that hasn't been present is those pools of capital that I just described. And I'm telling you, they're putting money to work. So if
Yes.
you, let's just use Athabasca as an example. Meg gets hostile bid. Who's next? Boom, Athabasca goes on a ripper. On kind of what's happening with Venezuelan stuff and these heavy guys coming in, Athabasca is down 20%. If
Yeah.
you take this too low, your boy Watchers is going to hostile bid that guy.
Yeah.
Like, just be open to the cycle and the big picture and what's happening, not so focused on the day-to-day headlines from the market, right?
Yeah, yeah. No, it's a good point. And I'd say like back in the day, one of the things that washed out of the market, this is a bit of an ad lib that I never thought of. So this is my on the fly, and I might be wrong. I mean, please disagree with me. I think one of the best things that came out of the marketplace, like there is volatility energy. I'm not saying this isn't for grandma. Like it is volatile. Investing in general has volatility within that. And I'm so glad, don't get me wrong, living through it was terrible when the when the trust market, blew up and none of these became really sustainable businesses, through the kind of government rules and, et cetera, et cetera. But being there sized appropriately within the portfolio, not just looking on them to solve the cash flow needs of your investor on a month-to-month basis. You have to have both short-term a short-term view, but medium-term and long-term conviction, on that. And so that's I'd say that's my compliment to myself is that rotationally and allocating based on size to portfolio and for risk tolerances and liquidity, makes the most sense. Let's talk about we'll jump into the next segment here. We called it subsector positioning and where Canoe is finding alpha. And I really want to compliment you and your group and your firm. When we look at a very sideways market, you guys have not just outperformed, you've performed, into, enviable returns. And so it's important that people understand, that there are subsectors and just uh, indexing here is not gonna matter. I'll say this to myself and how we've allocated is that we try at the most as a steward of capital, we try to allocate very significantly to indices where there's thematic tailwinds, where it's like all boats are rising in a rising tide. It keeps my liquidity high and my costs low. But I also am very well versed in the phrase that you pay peanuts, you get monkeys, and I'm happy to pay for performance when not just when people are performing, but where we see the macro and the micro starting to set up where activity is going to and alpha is created. So maybe you can highlight some of your differentiating processes and insights. So which subsectors do you see are mispriced right now? How does your subsector framework create opportunities that passive funds miss? Why are mid caps or intermediaries quietly outperforming and can continue to? And you guys have delivered strong returns even when oil prices were flat. What drove that?
I feel like you asked me 50 questions there
I
to make.
did. That was four with two in each. So yeah, that was a schmorg. And you don't have to hit on all of them. I
Yeah,
I, I think it's
I get what you're saying though.
people say yeah like energy and you look at it and say and I won't point to a lot of names and well I will you look at Canadian Energy Services CEO is the top performing energy name like way on the far right of the axis, and there's others that did terrible and then a bunch in the middle, so that you're playing that divergence and that opportunity set. So that's where
Yeah.
activity matters.
Yep. So let me lay this out. 2021, 2022, you're in the climate wall of worry stage. You throw a dart at a dartboard, buy any energy stock, we're all smart, it's all good.
Yeah.
Now the last 3 years, you're in the digestive phase. We're in the disbelief, haven't gone to optimism yet, as I kind of laid out big picture. But when you're in this sideways market, which you don't know how long you can stay there for, but like you don't want to be coming out of the digestive phase down 35% to your point. And that's when the manager matters. Like when we went underweight oil in 2024, massive call, everyone was bullish, Middle East bombs going off, talk oil was 70, 80 going to 90, 100, and we were like not seeing the right things. Sold our oils, got onto this power natural gas theme, big subsector call. That's why we outperformed in 2024. You flip it to 2025, not so much of a subsector call, more of a intermediates and stock call. When CES was down 40% last year in the middle of last summer, and there's quants blowing it out and some big institutional shareholders blowing it out, well, we became the third, fourth largest shareholder, right? As we mowed down the stock, and then it closed up 30 on the year. We were on this Clearwater oil theme. We nailed it. We own Spur, Headwater, Tamarack. Frustrated, frustrated, frustrated. Boom. Headwater's up 40, Tamarack's up 60 to exit the year, right? So your manager's been finding alpha on these themes. And you said, like, what subsectors do you like today? To kind of call it out since kind of December, stocks peaked, check back here. Then you get a choppy start to the year. Like there's actually quite a bit of stuff down, right? Like natural gas stocks are down. Natural gas, the commodities come in. People have forgotten about this power theme. You watch the oil side of things, like Canadian heavy oil stocks are getting sold here. It's just like, are you sure this scarcity of resource that I described, you shouldn't start taking advantage of that?
Still
On
in
the
that disbelief, right?
yeah, on the service side, it's just like services have been the worst performing subsector of energy for the last 2 years. Are you sure there's not some opportunity there? Royalties, like those stocks were flat last year. These are big weights within our fund. If you look at where other royalties and other sectors are valued, they're way higher. Like, so my theme for you is, are you sure you shouldn't have a few more intermediates in the portfolio versus large caps? If we inflect out of this disbelief stage to optimism, you'll want you'll want max risk, right? That doesn't mean we need to position for max risk. I just told you we own a bunch of royalties. Like that's the opposite end of the spectrum where we think we can make risk adjusted solid returns with some of that barbelled with the CES or Headwater or Tamarack. So, but
Yeah.
all I'm saying is a lot of people, when I hear them talk and they're like, first off, a lot of people are underrepresented in energy in their books.
Yeah.
Even on the institutional side, like we looked at a B of A report here 3 days ago. Sorry, lights just shut
Yeah,
off here.
I do that too.
Um, the energy weight in the S&P is 3%.
Yeah.
Well, the average institutional ownership of energy is 2%.
Yeah.
Like they're underweight the underweight. When I go to retail land outside of Calgary, I would say 50% of my conversations are, hey, where are you on energy? We don't own it. Like these are the good snippets that
Yeah.
I hear where I'm like, it doesn't mean it's the bottom. It doesn't mean it's inflecting tomorrow. But these are things that I like to hear as people are kind of underrepresented.
Yeah.
And they're sure as heck for the ones that do own it, and you go, what do you own? They're like Enbridge, Trap, C&Q, Suncor. And I'm telling you, why have we been outperforming the last 3, 4 months? Our mid caps, our Athabascas, our CESs, our Clearwater. Like, I think that's going to continue as we're in this kind of choppy sideways market, as that scarcity of resource theme that we talked about is going to be alive and well.
Yeah. Yeah. We'll jump into it. And it wasn't, I'll save the kind of the self-braggery of like kind of what we did with gold is you look at it, it's like commodity, large caps, mid caps, small caps. And I will tell you, and I've told it my clients and many other advisors too, is that what's really set us out for the pack is like understand what you don't know. And when you go down, just not the ladder of quality, but within market cap weight, you want a specialist. You want a specialist navigating those because it will matter at the basin level, at the execution level, at the management level. If you're going to proxy a sector, proxy the sector. You don't need Dave to do that. You don't need me to do that. We'll execute and take that thematic indice approach. But where you see the value add is within that. But let's talk about oil all the time, and you definitely touch on natural gas. But segment 6, natural gas, uranium, and power markets. We've definitely teed up a lot of that. we're going to talk a little bit. We've talked about AI, but maybe we'll talk a little bit about OPEC, maybe a little bit about uranium, and maybe pipeline capacity. But why is natural gas so undervalued relative to its importance to the power grid? And do you see a natural gas renaissance within the data center boom?
Yeah, so I mean, let's just start 50,000 feet on power. When you think
Yep.
about power and what's happening globally, again, let me just kind of educate some people on China. Like, you rewind the clock 20 years ago, China was importing 4 million barrels a day of oil. Today, they're importing 14 million barrels a day of oil, but they don't produce a lot of oil within China. They're getting this oil from Iran, from Russia, from Venezuela, from all these countries. And when you think about where China is at that 3 barrels per person per year, like they actually don't want to go to 5, 6, 7 barrels per person per year to be even more beholden to these Irans and Saudis and stuff like that on now we need to import 30 million barrels a day of oil.
What is
That is
the barrels per person used in North America?
20 to 22 barrels per person per
Yeah,
year.
so I think that's good context. Like they're not even wanting to go to 3 to 5 to 6, and there's
Yeah.
a big gap to where we are in the developed world.
Yeah. The developed world on average, to be clear, is 13, but like,
Yeah.
yeah, in North America, we're 22. So, but
Wow.
they don't, to your point, they don't want to go to 5 or 6 across billions of people because they're very beholden on energy security, which is that other theme that we talked about. So, what has China done the last 10 plus years as they're building out China? Well, they're actually doing it very smart. They're like, we need to push this power agenda. We need to electrify a lot of stuff. When you think about electricity, wind, solar, coal, LNG, uranium, like they're building all that out. They're building out more LNG storage. They're building out the Strategic Petroleum Reserve. Everyone freaks out on oil inventories that built in 2025. 40% of the oil inventories that built went to the China Strategic Petroleum Reserve.
Wow.
Well, they kind of look smart after what just happened on the weekend with Venezuela. So China is smart. They're electrifying everything, but they're not doing it on only ESG or only uranium or like they're actually spreading it out in a diversified way.
Yeah.
Their grid is 20 years old on average. The North American grid is 40. The European grid is 50.
Yeah.
We're very unstable. And so as I tee up this power thematic, then I laid out the 40 to 60 gigawatts of growth earlier of that means 40 to 60 new cities in the US when there's only 11 cities over a million people. This is crazy. And so I think when we put it all in a mixer, we are in a power super cycle. And like I kind of laid out, you want to own stuff through super cycles. You structurally own that. And I think there's places to be in energy specific to natural gas. When you think about this data center growth, it's got to be 99.999% reliability. The only things that get you there are coal, uranium, natural gas. That's it.
Gotcha. Gotcha.
Okay.
That's
So
perfect.
it's not going to be coal. It's going to be some uranium, but the average nuclear facility, when you go like the permits are ready to go on stream, let's start tomorrow, takes 8 years to build.
Yeah.
Like even if we bring some of this forward, like we're talking 7 years, 6 years, like we're talking 2034, like we're in a AI arms race globally. Like we need this power yesterday. Natural gas is the molecule and it's going to
Gotcha.
be needed and it's getting built and the oligopolies are forming. Like this is all teeing up for that avenue to be re-rated higher and the multiples higher and the recognizing of like these LNG facilities, yes, they're getting built, but they don't just last 10 years. They're 50 plus years.
Yeah.
Where's the resource going to come from? The market's still talking about free cash flow yields, not identifying the resource, but those countries of the Middle East and Taiwan and China, like they are going to come to get resource. The super majors are all inflecting back. BP, like the woman that just took over BP is from Woodside and Exxon. Like, you don't think BP is going to come back to natural gas as their hydrocarbon? They are. And Total's already doing it, and Shell will do the same thing. And all of a sudden, the world will need more natural gas resource as we re-rate it higher. So I
Gotcha.
think we're on the right theme there, but I wanted to tee up that electrification because it's important.
Yeah. Okay. Um, just in the interest of your time, we've got a couple segments left. This one, I don't want to, I'm an eternal optimist. But, let's talk about risks and what could change this thesis. I just want to, let's show a little bit of balance and, like you definitely have tempered, I remember prior to allocating to you guys, you were very caught. You're like, I'm not telling you it's the bottom. I'm like, listen, I'm a big boy, and we talk about the old 60-40 becoming a 60-30-10, and we're far debased off of a 60-40. We've got a lot of exposure to alternative assets, and I'm blessed with clients, that have, effectively grown up and sophisticated their portfolios and allowed us to prudently allocate them the way, high net worth and ultra high net worth investors should, more in line with pensions and endowments. But, we take a toehold and we build. But I do see, I was talking with a great client of mine yesterday, and it was a 2 or 3% position weighting that, that we've, tactically kind of got our shoes on, with you guys. And I said, I can expect to see, much like it's happened with gold, where portfolio weightings can be increased upwards of 10. And it's just, we'll do that thematically, programmatically, in a disciplined basis. But what are the biggest risks to the bullish energy thesis? And, where could we be too optimistic or pessimistic? And what data points are you looking for? What wakes you up in the middle of the night when you look at your Bloomberg and go, oh boy?
Yeah. And so again, let me tee this up on, I feel like the macro shifting. I feel like the pillars of the stool are in place for commodities. I feel like the setup is for like, don't get too bearish on the lagging commodities as everyone's now bullish certain other ones. So that's kind of the 50,000 foot view. But the thing that you don't know is like energy's all the way down to 3% of the S&P 500 as a weighting. Doesn't mean it can't go to 2.5. Like you can kind of always press these things lower than you think. So I'm a big believer of moving back to the normalization of the mean, and over time, like the macro shifts and other sectors that are very underrepresented in portfolios have their day in the sun. I think that's us. But on these big transitions where commodities structurally move higher and it puts pressure on growth sectors, and the rotation can be very sloppy, right?
Mhm.
Out of
Mhm.
growth into the kind of areas that have lagged for multiple years. So are commodities the driver of the pain, or do we have this bigger kind of broader market check back and global growth slowing in some version of that that kind of gets everyone a little spooked and everyone's racing for the trees on cash or some version of that? Those are kind of very valid things that could happen that I just don't really know. And so I want to be represented today. I want to have some cash just in case the shaking of the trees happens. But I kind of want to be there as I look at these 100-year charts, 50-year charts of price of oil versus S&P 500, earnings of the energy sector relative to earnings of the S&P. Like all these 100-year charts are like at the lows,
Mhm.
telling you to have something. So what would be a red flag for me if we broke the lows of the 100-year? Like
Yeah.
we're in an AI deflation or some version of that I did not predict,
Turns out it's all not real. Yeah.
and
Yeah.
I need to reassess my world. That is not my base case. But
Yeah.
I'm cognizant of where we are, and I could be wrong, but I'm not in that camp. I'm in the hard assets, commodities, currency debasement. Like I'm in that camp. And so those are the things I watch. Those are the things that I think we need to continue to respect. And like I just laid out, I ain't telling anyone today's the day. I'm telling you, I think the world is looking a lot different today than it did. And you should structurally build positions in an energy sector or commodities for what we think the world looks like.
Fair enough. Well, you pretty much like crushed the next segment. And so like just to not nauseum what we've done here over, we've been at it for a little bit. um you know those key points, like we don't even need to hammer them home. We're likely moving from an underweight to an overweight status over the next coming years, and energy being a hedge against deficits, inflation, deglobalization, geopolitical risk, like all of those things like really make sense. I kind of, with a risk of just burning and making CO2, the key themes are there. Value dislocation, the power super cycle and consolidation, private market conviction. That's to me, um, as a takeaway, and I didn't know that. And, every day I'm learning. I definitely, I don't know what I don't know. And it's why I surround myself with smart people all the time. And maybe that makes me smart too. But understanding that, for the private equity guys, this is a bull market. It's kind of like the bond market, or kind of like there are more sophisticated parts of the capital markets. And hearing that is really interesting. I think I'll wrap things up here, and I want to, this brings us kind of to the end of today's, episode, so a huge thank you to Dave Szybunka for sharing his expertise and giving us a clear lens into one of the most important and underappreciated themes in global markets that we feel. The big takeaway is we're in the early innings of a long structural shift in how the world consumes and values energy, and power demand is surging. Industry discipline is stronger than ever. Private capital is positioning aggressively, and public markets are still underweight, still skeptical in that disbelief part of the market that Dave discussed, and still mispricing what may be one of the most compelling long-term investment setups over the next decade. So, as investors, the goal is not to predict the future; it's to recognize when the present is changing. And today, that energy landscape is changing faster and more obvious than many realize. So, if you found this conversation helpful, follow the show, share the episode, stay tuned, for more insights as we continue to break down the key forces shaping markets and portfolios. Yeah, I'm Chad Larson. Thank you for listening again, Dave. Thank you so much for being here today.
Yeah, thanks a lot for having me.